Thank you very much, everyone. And I promise this is the last time you're officially going to hear from me, so you don't need to talk to me in the tea break. So thank you very much to our panelists. And we'd heard from the previous panel, the regulators talking about the value proposition from a regulator perspective, and very excited to have a panel to discuss from a capital market perspective. We're going to talk about the listed space twice from different perspectives, as well as then the unlisted space. Hopefully we'll manage time, and it seems that Annelie, my colleague from the JSE, you are on the left, you have the mic, and therefore you have the stage first.
Thank you. Good morning, everybody, and thank you very much, Tanya, and to the SUBSE for this opportunity. Certainly from a capital markets perspective, I mean, we first, biggest stakeholder, investors, we need to consider, their request and their need for standardized information. And we've heard this morning already from various speakers that investors are looking for consistent information and comparable information. And that information will then direct capital flows, and that's where the benefit would come for capital markets. We will be in a position to attract capital flows, specifically from institutional investors. Absent disclosure might result in foreign capital specifically drying up totally. So certainly, not only foreign, but local as well, but certainly from a foreign perspective, because they will have the disclosures internationally, and they can then make better investment decisions internationally. So it will put us, it will not align us with our international counterparts. So reporting is important, to stay aligned with international best practices. From a large local institution perspective, they're already feeling pressures, right? Indirectly from their commitment to principles of responsible investment, directly from their regulators, and we've heard this morning from the Prudential Authority, we've heard from the FSCA, that there's definitely a requirement for sustainability reporting. If we then look at our larger issuers, I mean, they're already reporting, right? But there's various frameworks in terms of which they report. Sometimes they report on a combination of frameworks, and investors, because investors are looking for consistent information and comparable information, it will definitely be beneficial for them to have a standardized framework. And they will have to spend less time giving various, pieces of information to investors. We've heard the big discussion earlier this morning about cost, but for the larger issues, because they're already reporting, the incremental cost to report on the standards should be fairly low for them. From a large emitters' perspective, they will have the benefit of managing their risks and having proper risk systems, and that could limit the litigation risk for them. And Tanya mentioned earlier the requirement from Europe, when you're doing business with Europe, to report. So certainly that will be a benefit from that perspective. I think what's important from a capital markets perspective is who's getting the benefit of the capital flow. And Tanya alluded to it earlier in her presentation, that not everybody will benefit at the same level. We need to do research, right? We just don't know where that cutoff is and who will benefit and who won't benefit. But it's important for us to do that research to establish and make sure that our framework for reporting is fit for purpose.
Thank you very much. Scott, I think you've had the enviable task. So those of you that don't know, there is a very active body called the CFO Top Forum. We certainly get lots of regulatory benefit, and they feed into a lot of our processes. They do have a sustainability subcommittee, and so Scott has graciously agreed to come and talk specifically without mandate from them. So I think you have that disclaimer. Anything you say and do is the views of yours alone and not of the CFO Forum. So with that introduction, I'll pass over to you.
Yeah, thank you for making that clear, Tanya. But having over a number of years worked with, a range of JSE listed companies from top 40 down to some of our smaller listed companies, I'll kind of give my 2 cents on the value proposition from their perspective. And I think what we've seen through everything that's been discussed up to now today has been, we are in a big state of flux in this space. So, the ISSB is very, very new. If you look at the pace that they have moved in bringing out S1 and S2 compared to previous IFRS accounting standards, it has been rapid. And Dr. Ndidi talked about the layered approach of standards following from that. We know that TCFD has been subsumed into the ISSB. But on the horizon, we just had the launch of TNFD. We have TIFD and SD in the inequality and social space. At the same time as the ISSB has put out its invitation for comment about their future agenda, which mentions biodiversity, nature, inequality, etc. So we have to ensure that cohesiveness continues globally, that we do not end up as fragmented as we are at the moment. We mentioned the alphabet soup that we have. And I think South Africa, both corporates, JSE-listed companies, the JSE itself, regulators have a role in trying to shape that global agenda in order that we get the value proposition we want. And I think it has to be said that, as was made earlier, the point that it has to touch the large non-listed space as well. We can't just say that because you're listed you have a requirement, and because you're not listed those requirements fall away. That creates all sorts of issues. So I think that has to be touched on there. I think, if we look at the JSE members, especially the kind of top 40, there's extensive sustainability capacity and expertise within a large number of those companies. So when standards change, or there are new standards or new revisions, there is the possibility of getting to grips with it. It's never an easy task, but there's the potential to get there, especially if you want to use the help of outside consultants in certain areas too. But in the lower listed space, that's a challenge. We looked at some of the numbers, 10.1 million, etc. I mean, I was having a conversation with a JSE listed client, a smaller company, a few weeks ago, where their total budget for anything sustainability related, including salaries and reporting, is 5 million rand a year. So it's tough in that space, and I think we have to look at the opportunities for different types of transition, the opportunities for ISSB for South Africa, without being so nuanced that it becomes totally different from the global version, to make sure that it fits into the space of those companies that, yes, are listed but are not, global size listed companies. And I think the value proposition for the JSE listed companies of really embracing ISSB and the way we're going in terms of sustainability reporting. It was mentioned the access to potentially lower cost finance. We know that in global markets, and South Africa is no different, that sustainability linked finance is becoming the norm. Companies that set out their stall with specific KPIs and meet them, whether it be on renewable energy or reduction of emissions or something in the social aspect, are seeing the benefits of that. I actually think what we're seeing now is it's become the norm so much that even if you are, say, renewing a loan facility or a rolling capital facility that was not sustainability linked, it now will be. That financial institutions will put pressure on you to do that. From an insurance perspective as well, it will help. We've seen that in insurance markets, and again global markets, in South Africa starting to follow suit, high emitting industries are finding it almost impossible to get any form of meaningful insurance capacity, which means you are taking all of that risk on your balance sheet. So companies who embrace ISSB from a reporting perspective that filters down into their strategy and what they do on a day-to-day basis and forces them to really plan for the future, it will have a benefit from a financial viability perspective and thriving going forward.
Thank you very much, Scott. So I'm hearing from Annelie certainly a benefit from big companies. Scott, I'm hearing the same from a CFO Forum perspective, and you've also then emphasized large emitters in terms of potentially benefit from that reporting. For the benefit of the accountants in the room, I must share a joke. You were talking about whether there was reduced cost of capital or not. So I did sit in about an hour discussion with a whole bunch of IFRS nerds trying to see if there was an embedded derivative, whether it was the risk or the sustainability that needed to be stripped out and accounted for. So there's lots of disclosure on climate and accounting as well. Shelley, thank you very much. Our lone investor on the stage and in the unlisted space. So we're very much looking forward to hearing your views.
Thanks, Tanya. So I think good morning still, everybody, and thanks very much for the opportunity. So I think that private equity, and I work for the Southern African Private Equity and Venture Capital Association, so I don't cover the whole unlisted space, and maybe that's a good caveat to start off with. It's a very small subsector of it, but it's definitely looking at about over 200 billions worth of investment. And where we raise capital from the international and the local markets, and mostly institutional investors. So we do a survey annually, and last year it was about 51% international and 49% local. Locals tend to be the pension funds as well as the insurers, some corporates, fund of funds, and the international tend to be the UK and European development finance institutions. So private equity has quite a long history of trying to think about sustainability. But what do we actually do? So in a private equity context, you raise capital from these institutional investors into a fund, and we then invest it into the unlisted companies. So venture capital is the startup companies, much smaller, really the kind of new tech, like sexy stuff, and the private equity is much more sustainable businesses that have been much more mature. But also what falls into there is infrastructure investment. So typically that's what we're looking at. And I think it's useful when we think about that in terms of the way we surveyed it. 83% of our fund managers, their key performance criteria were linked to goals that went beyond financial metrics. So 81% of the respondents also said yes to investors increasing pressure on firms to give them more ESG data. The top aspects where the investor pressure was coming from, 92% was an increase in the reporting for ESG, 79% to measure the portfolio company's performance against specific ESG metrics. So really, when we looked at the policy themes from an ESG perspective, they wanted regular external reporting on ESG initiatives, adhering to global sustainability initiatives, as well as establishing corporate social responsibility governance structures. So the pressure is definitely coming down from our investors into these private equity funds. What we find, though, in a private equity context, all of that pressure actually comes in the form of your legal agreements. So the way a private equity fund works is it's a 10-year fund, and you invest in your company, and the idea is you build a better business, and then you look to sell it to return more to your investors in the fund. So essentially, how do you build a better business? Often that's linked to improving all the ESG factors. So what you're doing is when you're looking to invest in that business, you do quite a deep dive in terms of what the ESG of the underlying business that you're going to invest in, and then you put a plan in place to actually make it better. So what happens in the legal agreements in these are really all contractual, and they go pages and pages where the international DFIs will list a really huge amount of data that they need, how does it work, and that gets reported back to investors. It just never gets made public. So that doesn't really happen across the board. It really is driven by investors. So in my mind, a lot of these disclosures, it really does boil down to what are your investors need the information for, and what are they doing with that information. Just producing information for the sake of it doesn't necessarily help. And what we found when we've spoken to the fund managers that have employed people in the sustainability side to try and actually help these portfolio companies to actually provide the data, interrogate it, analyze it, and then actually trying to do, what do you do with that data? Because private equity often take a seat on the board in the portfolio company. So you have a big enough stake that you actually have active management. So the idea about having all this data is to say, okay, what are we going to do to improve the company? What are they emitting? How are we going to reduce that? And what are we going to do going forward? So I think a lot of it has to do with the fact that actually you need to be reporting, but also reporting improvements year on year to make sure that you're actually doing something that it results in actions. And what we found is that unless you have buy-in from your board, that actually is just a tick box exercise. So again, it's just going away from a tick box exercise to actually making sure it changes. But I do agree that actually it needs to be implemented in a way in the listed and unlisted space. It would be great to say it's only a listed issue, but you will most likely have perverse incentives in terms of the listing and the unlisted space. And I think the only other thing that I would say is that when you look at the SMEs, we need to be very, very careful. They're in almost a position that it's really difficult to add any additional reporting obligations on them without breaking something else from a returns perspective, a job creation, all the economic side that they face at the moment. It's a really difficult business position to operate in. So that proportionality and how you balance the cost benefit, I think is going to be really, really important to make sure you are targeting it at the correct level, that actually it changes people's behaviors or businesses' behaviors so that actually your outcomes are the ones you're looking for.
Thank you very much, Shelley. So I'm hearing quite a lot and very useful insights in terms of your process and the reporting pressures that are coming through, but that very clear message in terms of proportionality, that will be very important. In terms of proportionality, Anli, perhaps it might be opportune just to discuss about some of the work that from a listed space perspective that we've played in terms of looking at segmenting the market.
Yes, thank you, Tanya. I'm sure the floor would know that we've recently embarked on some research on market segmentation, and what we're trying to achieve with that is to sort of segment the market in terms of the top 20, 30, 40, maybe 50, maybe 100 companies, and have different disclosure levels, different regulatory levels for the different segmentations in the market. And I mean, we've just heard from Shirley that we need to pitch disclosure at the right level, and certainly that's why we've considered general regulation from a JSE perspective in terms of the different sizes of companies on the JSE. So we've embarked on this segment, this research, and we certainly got very valuable information back from companies, from sponsors, from investors, and we're busy working through that. But that's certainly one of the initiatives where, from a JSE perspective, we can certainly, require disclosure or more disclosure at a top segment compared to a lower segment in the market.
Scott, in all of this, we're talking about the need for consistency. We're looking to extract the benefits, recognizing there are costs, so we want to really emphasize the benefits that are coming through. Some of my conversations with some of our issuers has been in terms of the number of data points and the number of reports that have to be done, not just in terms of disclosure frameworks, but in terms of, as I say, the number of reports and the number of people that you have to report into. I know that you work as a consultant in that space, and I know I'm probably throwing you under the bus. I didn't give you that script beforehand. If you don't want to answer, I'll pass the baton, but perhaps you want to share some of the pain points and some of those discussions and how potentially getting digital reporting in IWSB that we can try and move the market along, that you just report once and not 1,000 times.
So I think some of my clients would find that highly beneficial. If you look at, say, a number of our mining companies listed on the JSE, a lot of them are dual listed, so there may be differences in requirements between what's required from a JSE perspective, then out of London and New York. They're worried that the New York commitments might change depending on the results of elections. If the Republicans get in, a lot of what's happened in the last few years will be repealed. We saw that before. Also, you have industry-specific memberships of organizations which require further submissions. Some of it has to be publicly reported as well. So you really can end up with quite a significant burden in terms of reporting. We've talked about that term burden this morning and trying to alleviate that. So I think anything, be it digitization or harmonization of frameworks, would be massively beneficial to listed companies of all sizes and industries, because just now, while there is efforts to harmonize, there's also this incremental adding on top as well, be it from an industry framework, or if you now are realizing that you have a strong trading relationship with Europe, that CSRD is becoming the case. India also released quite robust requirements as well from a sustainability reporting perspective recently. So there's a lot at play, a lot that the companies have to consider in any way to rationalize that from a tech perspective, for ease of actually submission and reporting, or from a rationalization and harmonization perspective, I think would be welcome across the board, yeah.
Shelley, in the unlisted space, do you think that by having a harmonized reporting that we're going to be able to move the investors, or do you think we've got a lot of work that they're still going to ask for more and more?
So in the unlisted space, you will never, we don't see investments being made just on the information that gets given. So there's quite significant due diligence that goes into any investment. So we'll take the financial statements, but you'll do financial due diligence, you'll do legal due diligence, ESG DD, and commercial DD. So the idea that actually you're going to do it on information that's presented, whether it's audited or not, is the starting point. So I think information is useful, but they're going to dig a lot deeper anyway because they need more information, and it takes quite a long time. The idea is that at least that information would have already been collected. I think in a lot of instances, in a smaller company, it just doesn't actually exist. So if you go and do an ESG DD, you're actually starting from scratch, and they're trying to work out, the consultants are trying to work out, where are you, what do you need to do, etc. But at least if you've got disclosures, there is a base level. But the reality is that it's not everything that's going to be useful across the board. And again, I think the larger companies, it's much more helpful because then I guess in theory your due diligence cost will go down because you can rely on some of that information. But it's not going to eliminate it altogether because that's not the way that investments get made in an unlisted environment. So I think that we looked at it to be able to say, well, even in the private equity sector, we're actually trying to harmonize things in terms of how we report to investors. So again, that harmonization all the way up can only help in the long run, but it's just how you do it and how you actually manage those costs. So for us, at a private equity level, we've got lots of different investments that we then collect the data, get people in those underlying portfolio companies to provide it, and then they leverage off the ESG person at the fund manager to help with technical assistance or putting it all together and what they actually do that then goes back into their board packs to be able to improve their systems and processes. And then that then gets aggregated and gets reported up to our investors in different forms. And even that across the European DFIs, they can't even agree how that needs to be reported. So I think there's a lot of harmonization that's been, I guess, a long time coming and a lot of discussions, but actually practically doing it that will make it easier and simpler will go a long way to reduce costs ultimately, but it takes quite a long time for everybody to agree.
I'm hearing lots of work still to be done, and I think that is important. As I say, certainly in the listed space and the companies that I've spoken to alone, the concern is not only reporting, whether it be for the EU or the US market, but also in terms of the various rating agents. And MSI wants it one way, Sustainalytics wants it another way. And I guess that's a very important conversation we as a market need to have, is to make sure, once again, there is benefit to companies reporting once, is that all parties can then go to the central electronic repository and not to then have to fill in 1,000 more forms for each rating agent. I'm going to ask my panel if they've got any, each of them have any closing sort of remarks on that. I know I'm probably now way ahead, but I think we started. I haven't seen any times and cards. I think we were going to also have a fourth panelist, so we've been trying to fill in the space in that. Andy, I don't know if you want to make any closing remarks.
I think, Tanya, in terms of consistency, and I'm very interested in what she mentioned about, even Europe not knowing exactly, what the reporting should look like. So I think we need to be very careful in South Africa. We've heard about the cost of reporting. We know that the economy is struggling and that companies and entities are struggling. So I think we need to be extremely careful in what is that standard that we do require and that we align with developments internationally. And maybe we should take a little bit of time to decide what that standard should be to ensure that we're not totally misaligned with the international world.
I would echo the same sentiments. I think we need to monitor and be on top of international developments, but then think about it from a South African context of what's right for us in terms of reducing the burden to an acceptable level while not isolating ourselves from international markets. And then also when you look at that overall information that's being published in whatever format it may be, the credibility of that information and assurance is that next step, which I think is going to be absolutely critical as well.
I think in the unlisted space that access to capital is really important. If you can let companies believe that this disclosure will provide access to capital that they don't have at a rate that is more competitive or lower than they would otherwise be able to get, then people will do it and it won't be a tick box exercise. They will do it because they genuinely believe they are creating a better business and they are being rewarded for the better business that they are creating. The problem that comes in is that the costs that Tanya looked at versus how to create cost of capital that is that much for a small company is a little bit of a disconnect. So if we can bring that closer in line and that business case can actually be proved, and whether that's research or whatever it is, to be able to say that actually the access to capital and the cost of capital will be reduced, and this is how, if you do these disclosures, you will get much better buy-in from the, I want to say all companies, not even just in the unlisted space, because they can see the benefits and therefore they're willing to do it.
And I guess because I've got the mic, I can have the closing comments. And I think that's really, I just wanted to focus on an important aspect of the IOSCA endorsement, and IOSCA is very important to us from a capital market perspective, is really what they see as the benefit of the IWSB standards are these consistent, comparable information, and I think we've heard that from the panel today as well. They have not come out and said all jurisdictions must adopt the IWSB standards as is. They've asked their member states to consider the manner in which they should adopt, adapt, incorporate those IWSB standards into their jurisdictions. So I think they very much recognize that this has to be a jurisdiction by jurisdiction response to make sure that we have the most appropriate way forward while still ensuring that we remain an attractive investment destination. Thank you very much to my panelists.